and tell him where he's wrong. I'm joking, sort of. He's very modest. Somehow he went to college in the Midwest. He's got that Midwest modesty, Stephen Burke. We're almost at 11. Anyone else before we're going to move the trade? You mentioned though Tudor. We have a Michigan and Denison heritage. So Mark Dalton and Peter Borish. I'm sure you ran into them.
Yes, Mark Dalton was the longtime president of Tudor Investments, and I worked closely with Mark for many years. An excellent individual, real professional. We both started our careers at Kidder Peabody, Mark and I. So great affection for Mark.
By the way, just to be clear, you cut out on me for a second. Since you're going to be speaking, I want to make sure that it's not your side, it's my side. Did he interrupt, or is it just my side? Just to clarify.
I heard him well.
Okay, so it must be. I remember when we first launched these Zooms, Stephen, if my Zoom went down, we lost 200 people during first weeks of COVID.
You've come a long way, Mark.
We've come a little ways. So with that, it's 11 o'clock. I'm going to start turning it over to Stephen again to remind some of you. This all started in September 2019, not 361, but Stephen Burke coming to speak in front of us because Rich Sobel said, maybe you should stop speaking and let Stephen kick these things off. He's actually got something to say. And he had read 5 newspapers. We were at Denton's, I believe, in London. And Stephen was talking about whether, what was the topic, Stephen?
Climate change, inflationary or deflationary.
That's right, global warming. And it's just like Machiavelli, the answer was both. So
that's what I went with that day anyway.
Yeah, it was a great discussion. It set the tone for day 2 of London, and he's been doing it. We did it in Texas a few times, and then Ohio, and then COVID hit, and then as soon as COVID hit, we sat here in our rooms and went to Zoom, and Stephen started. So 263 Tuesdays later. Over to you, Stephen.
Before we start, Mark, I just put into the chat, we're hosting a call today at 1 o'clock with Ed Yardeni, who's going to give his reflections on the first 90 days of the administration. So feel free to join. If you sign up, you automatically get the replay sent. So if you can't make it at 1, just sign up, and or you can go to our website or LinkedIn page and see it as well.
Can I just ask a question on that, Steve? Who does not know Edward Yardeni? Put your hand if you don't know him. Depender, Tim, Marina. You want to just explain who he is?
Yeah, he's actually one of the leading strategists and economists on Wall Street. He's been doing it for over 50 years. And he actually coined the phrase bond vigilante back in the 80s. But he's been one of the, I think, most accurate strategists on the street for some time. And he brings a very plain spoken, very balanced approach to it. So it'll be a well worthwhile presentation. So feel free to join if you can.
Excellent.
Mark will get started. Just give me 1 sec here.
Again, I appreciate the tie.
Thank you. Okay, we're good to go. So clearly there's a lot to discuss with everything that's going on in the world today. And I'm particularly interested in hearing Scott's comments about the dollar, because that's one of the things that's been highly impacted by the trade reboot. The euro getting up to 115 yesterday, or right around 115 from around parity not too long ago, is just a sign of the times we're living in. But there's certainly a lot going on. And what I really want to highlight today is a report out from the IMF. They just produced their latest World Economic Outlook. and they came up with their revised growth projections, which they do this basically October and April every year, and they do interim updates. So from January, they lowered their forecast for global growth for this year and next by 1%. They took this year down by 0.5% to 2.8, and next year down to 3 from 3.3. They are actually, to put it in perspective, if you go back to 2000 to 2019, the average GDP growth rate for the world was about 3.7%. So this is a pretty good knockdown from where we've been for most of that time. The US was brought down about 0.9%, looking at 1.8% growth for next year, and the Eurozone knocked down about 0.6% to 0.2% growth. Emerging economies are going to see some mixed impact from this, but clearly this has been a challenging adjustment to global activity, and its impact will be felt for some time. We've talked a lot about economic policy uncertainty. This is a chart that is just on trade policy uncertainty. And you can see this is really off the charts. So while economic policy uncertainty was elevated to where the 2020 period was with the pandemic, this is unprecedented, whether it's at any point in recent history, as you can see how unusual the trade policy uncertainty is and will be for some time. As we saw in the last month, we had a 90-day stay of the increase in tariffs on certain goods. Then we had it lowered. Then we had it put on electronics, then taken off, but said we're going to look at it in a different way. And those are the things that are keeping us in this highly uncertain period. And at the same time, you have companies and countries trying to figure out how to respond. And it's not just the straight tariffs that are the problem, but the non-tariff barriers that have been rising for some time that the administration's trying to figure out how to counter. And but it's been done around the world. You look at the 3 largest economies, China, the EU, and the US, and each of them have been pretty aggressively ratcheting up non-tariff barriers, which include things like regulations, import bans, quotas, advertising rules, or complex or discriminatory rules of origin for imports, things like that. These are all the elements that are going into these trade negotiations. And for perspective about how long this might take to get resolution to, what we've seen, and Thorsten Slock from Apollo put this out, I think typically trade negotiations can take anywhere up to 18 months, and we're trying to do 70 countries in 90 days. I suspect come July, we're going to be either saying that we've gotten enough that we can ease off or pull back if the economy is cratering too much, or you're just going to have an extension and more of the uncertainty persisting for some time. But I wouldn't expect the tariffs to go away, and I wouldn't expect the barriers to come down, the trade dollar amounts to come down, the percentages to come down that much. So I think there's 3 things to think about with trade, and this is where the IMF's take is. Uncertainty is expensive, and it is impacting business decisions, shipping costs, investment decisions by companies, by consumers, by businesses. It's changing the terms of trade. We've had some of the greatest swings in market volatility in a single month we've had throughout, and it's having behavioral changes where people are getting ahead of either front-loading purchases to avoid tariffs, which are going to distort economic activity in the short term, or pull in savings, which will create the paradox of thrift, which would create the slowdown that we're trying to avoid. At the same time, trade barriers hit growth initially, and then you get benefits maybe later on. That's the hope. But I think right now you're seeing these tariffs being paid by exporters, importers, companies, and consumers are all taking the hit. We're going to see higher cost of living. Whether it's inflationary or not depends on whether we're going to keep dripping and drabbing tariffs in, or we're going to get to a level and set it, and then that's going to be the new tariff level, and that becomes a cost of living increase. So I think we have to really balance the two off, and this is creating big problems for decision makers. And the other thing is it does impact productivity, particularly over the long run, but more importantly, it damages it very much in the short term. And that leads to bad decisions for capital allocation. It hurts innovation, and it does slow entrepreneurship. And a lot of the tariffs will impact, as I mentioned, the small businesses the most, smaller nations and small businesses. So we've had this jump of tariffs up to this level that we're seeing now, plus or minus, 20% range. The question is, what happens next, and do they go down much? I don't believe right now, based on the way the administration is proceeding, that I would expect to see a big return to lower tariff rates unless the economy really craters. But I think this is more of a long-term plan to remake the US economy and the global economy. And I think they're using this as the tool. They believe it. Whether it meets the economic standards that most others would apply doesn't really matter. I think this administration believes in these policies. The president absolutely believes in tariffs. And I think the expectations that there'll be a big come down in tariffs may be an area that the market will be out of step in. This is where the pain is felt, and it's felt throughout by small economies, but it's also by small businesses. And the US, the EU, and China are going to be dealing with a battle amongst themselves, and then the other nations are the ones who get most impacted by this. I think this is one of the big areas to watch for pain points. And as the negotiations go on, trying to force nations to choose sides, I think will lead to a bad outcome for all involved. But that is the direction we're going, and I think that's where the trade uncertainty is going off the charts. So how do nations respond? According to the IMF, they think they need to do 4 things. Get their fiscal houses in order, and that means stop delaying making required investments, make the hard decisions, implement gradually the changes you need to make, but be honest with the population about the challenges and trade-offs. And if you go back to 2008 and look at some of the southern nations in Europe who took the pain and how they're positioned right now, because they dealt with the problems and dealt with the hard truths, they got their houses in order, are now in much better shape than they've been at any point in time. Think about Spain and Italy, among others. So we're going to have to take the pain. You have to get your house in order. And I think most nations are dealing with limited fiscal space right now. I think this is part of the reason China's been so slow to stimulate earlier in the year, was they were waiting for the tariff hits to come because they knew they were coming, and they didn't want to shoot the bullets before they had the opportunity to really deal with the bigger issues. I think the second thing is monetary policy has to remain flexible, and that goes back to something we've talked about a lot in recent weeks about the two-sided risks that central banks are facing. You have slowing growth and you have inflationary pressures rising, and how do they balance the two off, and how do they make those trades? I think central banks have to be prepared to move in either directions. You've heard that from Christine Lagarde. You've heard that from Chair Powell. You've also heard that from the People's Bank of to be able to move in different directions. And right now you have the President, Trump, putting tremendous pressure on Chair Powell to lower rates and even get fired. I don't think that'll help the US in any way, shape, or form. I don't believe Powell will step down. I think he believes in the independence of the Fed. And I think this is a fight he will take on to the end. And I think that'll go beyond. And I think that's what's led to this week's problems, and why we're focusing on this right now when we have all the other issues to deal with. It doesn't make any sense unless you believe, as some people do, that this is to scapegoat Powell for a recession that might be coming, and not the administration's policies. I think the fourth thing that you have to focus on around the world is debt sustainability. Smaller economies are getting hit by this. They're going to need to ask for support and even restructuring. And this is going to come at a time that the US is not as eager to support the multilateral institutions that were set up after World War II. And that's going to be an impact as well. And then lastly, what nations need to do is lift their productive potential And that means they got to put the ambitious reforms in necessary areas. And in Europe, that can include strengthening their banking industry. It's about strengthening capital markets around the world. It's about investing in infrastructure. It's about getting the competition policies right. And it's supporting innovation and entrepreneurship and eliminating the self-inflicted injuries that are being created by governments around the world that limit productive potential. That's a key area for us. So just quickly, we have debt much higher in the advanced economies and emerging economies than they were at trend. Before, we have to get the fiscal house in order, bring debt down. Debt is the current consumption of future earnings. And with some of the pressures that I think are going to be coming from the trade issues that are going to push costs up, that's going to put greater demands on the government at a time they can little afford that. And it's going to lead to hard decisions by governments have to be made. I think the productivity issue is going to get hurt in the short term, but companies and countries that can improve productivity and look at the gap between the US and the rest of the world from the financial crisis, what happens going forward will be the determinant of who are the big winners and losers in the global economy. But it's going to be very difficult for smaller nations to manage through this. And this is really the changing terms of trade in the reboot that we're looking at. This is how global manufacturing and the share of it has evolved and where the value add has come in. And how do we bring this in line? And what happens with China's excess capacity in the near term? And how soon can they rebalance? These are all issues that are on the table right now. So as it relates to the market, and we'll move to the discussion on the dollar right now, I think the year-to-date performance derby has been fascinating. You had out of the blocks, the US was looking quite strong, but then Germany made their announcement of releasing their debt brake and increasing their infrastructure investment. At the same time, Europe made their announcement on increasing spending, and you saw a move up, but then that got a little bit curtailed by some of the other trade issues that are coming and the reality of how do you get all this done in a timely fashion. China also saw a bit of a rebound and now is flattening out, and the US and China Japan are in a different spot. So I think we're going to see this performance derby moving quite a bit this year. I suspect that people are now reassessing where we are with multiples. The hard part for understanding how to invest in this environment is nobody knows what earnings are going to be right now. Therefore, you can't really determine what multiples are going to be. But multiples have come down. And just for perspective, in the US, the Magnificent Seven have moved from a multiple of about 33 at the start of the year to about 22. The S&P has moved from about a 22 multiple down to about a 17.5, 18 multiple right now. So you have seen some pretty dramatic moves. I think this performance derby will be one that will be determined by how aggressive and how far we go in the US with the trade and how much it impacts the other areas. But I would say that the US should start to find more normal footing. And I think that Germany and China will do okay. But I think the issue is to be balanced and not to be chasing and running too far away from any one of these markets and not rushing too fast to anyone because you've gotten good news, because good news is followed by bad news pretty quickly here, and the unpredictability of trade policy and other fiscal policy and monetary policy will be at play here and will create some big distortions as we're seeing in the currency market. So Mark, I think we can jump right to currency if you want to hold up for questions till we get to the end. That's your call.
So maybe, Scott, you just jump in on that, and then we'll do questions together.
Okay, thank you, Mark. And Mr. Burke, that was a fantastic program there, and I think sets me up really better than I could have ever imagined. You covered some of the tectonic shifts going on. What I want to try and do is distill down this report that I wrote back in March. And I came at this not as an economist or a currency strategist. I came at this as someone who traded currencies for 15 years, as someone who has been a trader, a portfolio manager, an asset allocator at the nation's largest public endowment, and also as a strategist, a macro strategist who looks at the big picture. And so I didn't come at this from the traditional means. And my wife, who is also from this industry, read my report, said, "What do you know about currencies? You're just a trader." And I said, well, I wanted to come at it from a trader's perspective. And it took me 6 weeks to write this. It was about 8,000 words. And it was one of the longest reports that I've written here as the strategist at Capital Creek Partners. But I really took the time to delve into it. And I really had no idea that we were about to kick off one of the biggest devaluations in modern US history of our currency. Just to give you some perspective, since the Trump administration took the reins on January 20th, the US dollar, which is really a pretty non-volatile asset, has fallen 10.5%. 10.5% in less than 100 days. That is a staggering move. That is basically like a major currency devaluation. The price of gold since the Trump administration started is up 35%. That's the biggest move in that short period of time since 1980. So really amazing moves since Inauguration Day. And so I want to try and hit the highlights of the report. Hopefully we can get a copy to you to read in long form for those who want to go into more detail. But the dollar over the long sweep of time, although it's the reserve currency, it's really been a poor store of value relative to real assets like gold or homes or financial assets like equities or long-term treasury bonds. You need to really limit the amount of your assets in cash unless the real interest rate on cash is very high, like it was in the early 1980s. It's not that high today. It's about 100 basis points. Inflation's 3%. Policy rates are 4 3/8. So you're getting a little bit of a real return, but it's not a great real return like we had in the 1980s. So I think point number one is just limit your exposure to dollars as a store of value over time. It's just not a great store of value. It's exposed to moral hazards like money printing and taking rates to zero and engaging in things like QE for political purposes and to spur the economy. So it's just, you've got to be careful. It feels great to have cash right now because assets are going down in value. But remember, there's a cost to having cash. There's inflation. And a lot of the time it will hurt you to have too much cash. We now appear to be in a new monetary era where the dollar is likely to play a diminished role, in my opinion. I've coined this acronym called CINKRS, CINKRS, and that stands for China, India, North Korea, and Russia. I'm sorry, not India, Iran. So those are the CINKRS. And they desperately want a new currency to transact, and they do not want to transact in US dollars. That's a group of adversary countries for the United States and for the West. And they don't want to use the dollar. They don't want the US to have this exorbitant privilege of being able to borrow at lower rates than we probably should be, to be able to issue treasury bonds with impunity and build up our defenses. They see this as part of American hegemony, and they would be thrilled if the dollar lost its reserve currency status. And they're working very hard to undermine the US reserve currency status, in my opinion. Meanwhile, the administration appears to want to try to share the costs of the reserve currency. And there are costs. We've seen these costs in a hollowing out of the manufacturing base and persistent trade and budget deficits are part of that. The reserve currency allows us to run these gargantuan budget deficits. So it's not all a one-way street. I think that for America, the benefits of the reserve currency far outweigh the negatives. But as we know, the Trump administration is transactional in nature and very focused on trade, and they see deficits as a bad thing. There's certainly debate about that, whether that's the right way to look at it, but that is how they view it. And I think in some ways they don't love the reserve currency status of the US dollar. In fact, Treasury Secretary Bessent has called for a new monetary order, but he has not given us any vision for what that would look like. What is Bretton Woods 3? What is the next new monetary order? We don't know. We just kind of know we're going through a chaotic period where big change appears to be in order. So that's my second point, that we appear to be in a new monetary era, but we don't know how to define it. And point number 3 is that the Trump administration is hyper-focused on trade. When I look at the issues that are important to the American people, trade is way, way down the list. It's not even near the top at all. But for the administration, they decided to lead with trade. So I think a lot of the voters back in November thought they were getting robust growth, animal spirits, deregulation, tax cuts, and whoa, that's not what we've gotten at all. They led with trade, which is really a headwind to all of those things. In fact, every one of those things I just ticked off has either been stymied or is facing headwinds because of the trade policy. So investors have been very surprised by this. I think voters have been surprised by it, that we've really gotten, at least in the first 100 days, a very different policy mix than we expected. So my analysis is that tariffs alone will not be enough to eliminate the US trade deficit. That it may not be possible to eliminate it entirely, but a weaker dollar will almost certainly need to be part of the policy mix if that's what you want to do, to really work down the US trade deficit, which from the president's, what I would call mercantilist perspective, that if you're running a trade deficit, you're losing. I don't see it that way. I don't think a lot of economists see it that way, but that is how the president has viewed this since the 1980s. And he's been very consistent about it. And Mr. Burke is right that trade is a huge focus of this administration, and it's upsetting a lot of things. So as a result of this, there's been an exodus out of US assets and consequently dollars. We're in the middle of it right now. I gave you that stat, down 10.5% since the administration took the reins on January 20th. I've also found it to be very interesting that not once in my recollection, and I even searched, of course I used AI to look for quotes, but not once has Treasury Secretary Bessent or President Trump supported the dollar since Inauguration Day. It's just kind of been benign neglect. They know it's going down and going down hard. But unlike previous administrations when we've been in dollar declines, there really has been no effort to support the dollar or jawbone it up. If anything, it's been the other way around. So I think there's a clear desire for a weaker dollar because it does help exports and it does depress imports. Imports become more expensive and our exports become more competitive. So it makes perfect sense that they would be following this policy if the focus is on trade. My fourth point is that, and I think this might be the most important thing to take away from my analysis today, that the relative price of the dollar compared to other fiat currencies and other assets like gold reflects investors' confidence in the collective policies of the Fed, the Treasury, and the administration. And I think confidence in all three of these areas has been falling in 2025. And I think that ties right into why the dollar has been falling in 2025. So point number 5 is that I think we're seeing, at least in the near term, the unwind of this concept of American exceptionalism. And American exceptionalism really has been built over the last 15 years of fantastic performance by US equities for the most part. Fourth quarter of 2018 was a quick bear market. We all know the pandemic in the first quarter and second quarter of 2020 was a brief recession and a deep bear market that we V-shaped out of that very quickly. But all during that 15 years, pretty consistently and sometimes dramatically, US equities outperformed the rest of the world. And I believe that was because of our technological advantage, that American corporations not only innovate technology better and faster than anywhere else in the world, they're very adept at deploying it into their businesses.
Use the tab key to navigate and press space to toggle an option.
They're very adept at using technology to maintain and even increase their profit margins. They've been so good at it. We do capitalism better in this country, I think, than any other country, at least as it flows through corporate balance sheets into earnings, returns on equity, and shareholder performance. And the world understands this. They know this. But in 2025, investors are seeing chaos in US policy. There's been so many changes so fast, so many executive orders, so many measures that almost seem to be at odds with each other, that I think investors have looked at this and said, you know, there are much cheaper assets elsewhere, in places like Germany and Europe. Okay, the growth is slower in Europe. The corporate performance is not nearly as good, but the assets are cheaper and the policy mix seems to make more sense. What is the ECB doing? They're cutting rates over and over and over again. They're now way below US rates, half of US policy rates. What else are they doing? They're starting to use fiscal stimulus as an offensive weapon because they know that a global economic slowdown is coming. As Mr. Burke mentioned, the IMF cuts to GDP growth this morning. Big cuts, by the way. China, very cheap assets, reviled, hated, uninvestable, right? Uninvestable, but they're very cheap. And what is the policy mix starting to look like in China? Well, fiscal stimulus. They have more policy space than the US. The US is actually through Doge, and rightfully so. We need to get our fiscal house in order. The IMF is absolutely right about that. Probably as much as any country. We are on an unsustainable path. And so our fiscal policy space is very narrow. The Doge policies are actually, I think, contracting fiscal policy at the margin, even though they're cutting very little in spending. This Doge mentality, I think, is permeating down into state and local governments, even corporations. And so I think this is taking some of the fiscal impulse away. It's been very effective that way. So American exceptionalism is on the wane right now. I don't think it's over. I think America is still very exceptional, but it's expensive. And policy mix is chaotic, and trust is waning in American policy. So I think that's leading to dollar decline. That's leading to an exodus from US equities and bonds. We saw it 2 weeks ago. We even saw it yesterday. How about yesterday? Stocks down big, yields up big, dollar down big. That's a very unusual combination. I can promise you, I've traded these assets for most of my career. You almost never see that. We've seen it 2 significant times in the last month. So that's a toxic combination. And I think it tells me that assets are leaving the United States. So I'm going to make the case to you. Mr. Burke made this case a little bit in his comments, but I'm going to make the case to you that high tariff policy is bearish for the US dollar for the following reasons. High tariffs weaken growth. That's obvious. It raises prices. Very obvious. I think it's going to raise unemployment in this country. It's going to reduce competitiveness. And it does this because if you have a price umbrella, if you're making automobiles and you've got a 25% price umbrella, you don't necessarily have to be as innovative. You don't have to be as competitive. you've got a shield. Your vehicles will be more attractive based on price, if not quality, simply because there's a tariff in place. So you don't have to be cutting
Scott,
anymore.
Scott, as you make the case, just I'm gonna move into a Q&A soon, just if you don't mind.
Okay, I'll just wrap up. I'll finish with why I think tariffs are bearish. They reduce competitiveness, they weaken US alliances, they reduce American soft power. And I think this is so important. What is the brand of America? Well, the brand is being diminished, I believe, by these tariffs. And it reduces the desire to hold US assets. And remember, when you run trade deficits, the mirror image or the other side of the coin of a trade deficit is a capital surplus, capital account surplus. So if you take the trade deficit down, you're going to take the capital surplus down. And that corresponds with people moving assets out of the US to other countries. So the trend in the dollar is down. I think the pace has to moderate from here. A 10+% reduction in 2 months is staggering. It won't continue at this pace. We probably have a rally very soon in dollars. It's gotten a bit out of hand. But the bottom line is the people on this production here ought to diversify into foreign stocks, foreign bonds, real estate, copper, gold, uranium, things that can't be printed, oil. But you need to diversify. You can't have too much of your money in US dollars over the long term. So Mark, I'm done.
Thank you,
Take
Scott.
it away.
What I'm just curious, what do you, the two of you, because you do similar sessions on your side, is there something that Stephen said that you might disagree with?
Yeah, it's, as I listened to him, and I tried to listen carefully because I thought there might be an introduction in this, and there was. There really was almost nothing that I disagreed with him on. And I would have been polite and probably wouldn't have disagreed with him anyway until you asked me. But I can't recall anything that I thought that I really disagreed with. I thought he laid it out very well.
And Stephen, anything you heard from Scott that you either see differently?
No, I don't know what the alternatives are that will continue I agree that we should see a bit of a rally because it's gone too far too fast. I think the surprise is going to be that, the euro's moved up a lot. I'm not sure why, other than the talk about it and the challenge with the Fed. I think the big issue is in the last day was really just the attack on the Fed has really unnerved everybody. Because Fed independence is paramount. So
if I could touch on that for a moment, I'd really like to take that up because I personally know Treasury Secretary Bessent not well, but we're acquainted. We were investors in his Key Square Fund when I was the head of asset allocation at UTEMCO, which is the University of Texas Endowment. Jay Powell is very concerned about his legacy. He is not going to step down as the chairman of the Fed. And I don't think Donald Trump can fire him, but I think he might push the envelope and test whether he can fire him. It would be a very bad move, in my opinion, because it would further undermine confidence in the dollar and in the treasury market. And your next speaker, Ed Yardeni, is a good friend of mine. I have tremendous respect for Ed. Everyone should listen to his presentation. And this concept of bond market vigilantes, believe me, the vigilantes will be on their horses and they will be riding to the OK Corral if Chairman Powell is removed as the chairman.
Well, Scott, since you know them, who do you think, and this is Wanda's question from last week, who's the voice of reason? Trump 1.0 had some voices for a while, right? Or what, we thought it was the markets he listened to.
He definitely had some voices of reason. He sure did. And he tended to fire those people who pushed back on him. So I think that there are not very many people willing to talk truth to power in this administration. Even Besant, I think, is definitely a voice of reason, and I have great respect for him. He does understand the markets, and I will tell you, Scott knows the currency markets very, very well. And he was a major currency trader at Soros and at his own firm, and for Stan Druckenmiller. And think about Scott. He worked for George Soros and Stan Druckenmiller. Those are two very, very tough taskmasters, and he survived them just fine. So he must be a good politician himself, but I don't think he can really. I think he's limited in how much he can influence the president.
Mark, I think the answer to that question is the last guy in the room is who he listens to. It really is. When they got the 90 days, it was when Navarro wasn't around, and Besant and Ludnick went in and got him to postpone it for 90 days. But if Navarro was there, it might not have happened. So you got to be careful about who he speaks to last.
Fair enough. But I got lots of questions, but let's open it up. Any questions from the community?
Mark, on that last point, guys, I mean, Trump may be a bit erratic, but he's rational at some level, right? I mean,
No.
the reason he had the 90-day pause because he saw what was happening in the market. He doesn't want his legacy to be a recession or a fall in the stock market. So rational heads prevailed. With Powell, isn't it the same thing? Of course, he's complaining and whining about lowering rates, but what happened on Friday with the markets, I mean, is not going to give him pause to be like, look, if I actually fire this guy or replace him with a dove, then the markets are going to tank. And he doesn't want that either. I mean, isn't that reasonable to assume?
Well,
So
the
this is
markets
all
already have tanked, though. Let's be clear. We've had a pretty significant pullback in the stock market. The bond market's been all over the place, and you just heard currencies have been thrown for a loop. So it's coming off a big year, but I mean, he did react to the bond market. That's what he reacted to. I'm not sure. He's already said he's willing to take a recession. I think he's looking to blame Powell right now for it if it comes. So I'm not sure it's been as rational a policy as you might want to describe, Roger.
Let me throw this. If we get lower rates and we have a smaller dollar and we have exports, even though we don't have reindustrialization and great, we can't accelerate that as fast as we wanted to. What does that scenario look like for investors?
Lower rates, slower growth, and fewer imports. I think it's probably ultimately a disinflationary environment. I've been wondering, are tariffs ultimately deflationary because they hurt growth? So we get a one-time price increase, hopefully a one-time price increase, and companies don't abuse it and use it as an excuse to raise all prices. But I think it's going to be pretty taxing on growth, and ultimately that's the big outcome. And Fed policy will ultimately have to respond to that. And I think there's a potential to cut rates at every single meeting after the May meeting. We might have 5 straight cuts this year.
Fair enough. We got Rob, Melissa, Adam, Jim, and Bill. Let's do it. No long comments, just quick questions, please.
Sure. Thanks, Mark. I like the flavor of dialogue this morning. To the first point about who has Trump's ear in the private ear, in the first administration, I think Ivanka and her husband had pretty much interesting ear. I wouldn't be surprised that one of the family gets more active just because of necessity. And then secondly, this talk about Powell and what have you. A couple of us were at this gathering last week with the Apollo economist, and this kind of goes back to Trump's roots of firing away multiple cylinders, real estate negotiation, New York style, and I think he gets his pound of flesh, but I think what was mentioned a little bit ago of settling down to something more moderate. So the tariff
Rob-
war from 90 countries, I think it could be reduced. So I'll stop there. But I just think some of this is a lot of um, a lot of interesting talk. He gets his compromises, and then he settles down. I'm going to hear the others.
Okay, well, this is being recorded, so we'll see if you're right. Melissa? If you're not ready, Adam? Adam's always ready.
Good morning, everyone. Mark, Scott, thank you very much. My question is, how permanent is this damage to the US dollar and to our economy? That's it. That's my question.
It's a good question. It's one that I've pondered myself. I don't know. I think that it has taken us 250 years to build up trust in the dollar. I think about our relationship with Canada. We've been good neighbors for 250 years, and we've really damaged that relationship severely, very quickly. Look, I think the likely scenario is we are going to have a recession in 2025 because things have really just stopped now. Corporations don't know what to do. They're not spending. Consumers are scared. Markets have come down. A lot of wealth has been destroyed. We were slowing anyway. The Fed's got to be, they haven't been able to cut because of the uncertainty with inflation and tariffs. So I think we're going to have a recession. And that probably leads to a change in congressional majorities in 18 months, and probably a lot of the domestic policy action has to stop. But the foreign policy action can continue. So I think it's lasting damage, but I think it's part of the process of the US dollar slowly losing its reserve currency status. There is no clear alternative. The euro is definitely not an alternative. The Chinese RMB is not an alternative for so many reasons. Bitcoin is not an alternative yet. There's not enough gold for it to be an alternative. We probably can't conceive of what the alternative is, but it will appear sometime in the next several years, in my opinion. I think it's lasting damage. I don't see it
Scott.
easily unwound.
Jim?
Hi, good morning. Mr. Berg, Mr. Slay, appreciate your analysis, and I agree with it as most likely outcome. However, markets price and expectations. So what else can go really bad and what else can go well?
I think it's a good question. And Mr. Burke, you want to go?
I would just say really bad is that the negotiations keep going on, and that we're in this, you don't get to any level of certainty that allows people to understand what the rules of the road are to transact. And that's actually, that uncertainty is what's slowing down, what's creating the slowdown, is you're having a pullback in spending on all levels, whether it's federal government, state, local governments, corporations, and consumers. So it creates a self-fulfilling prophecy. So I think that's on the negative side. On the positive side is you get Japan and Korea and the UK and maybe Europe, Canada and Mexico to come up with some kind of negotiations that are more that say that we've done something and that you then back off and move on. I think that's the positive side, and he gets an off ramp and can declare victory, and we bring the tariffs back down to a more reasonable level, like a 10% level or something like that.
I think a really bad scenario is that we're sitting here in July, August, and there's absolutely no deal between Xi Jinping and Donald Trump. If you think about the way that these two men want to do a deal, they're completely different. President Trump wants to deal directly with Xi and cut a deal between two leaders. Xi wants to have other people in his administration deal and have it bubble up, and he comes in and signs the deal. They don't see. They're two strong men, prideful, tough guys, and it's going to be hard for these two to do a deal unless things are really bad. And I think that might be how we get to a deal between these two countries. There absolutely has to be a deal. We cannot have 145% tariffs. between these two countries, or we'll be in a global recession. How good? What could go right? Well, maybe we've seen the peak in tariffs and all this chaotic talk. We know investors are very underweight equities. That the pessimism is extremely high, not only for stocks, but bonds and the dollar. Pessimism is extremely high. Anything that goes right, I think if the president and the administration just stopped doing anything for 2 weeks, we got a huge rally.
All right, thank you.
Bill?
Next. Bill?
Yeah, no. Fascinating as always. Yeah, Scott, to your point, I think you're right. The cure for high prices is high prices. There will be a point where that's going to be the cure. And yeah, I think long run, this is an interesting deflationary case. You know, one of the other things is that, you know, I think as people have thought through, you know, now that we're experiencing this whole trade thing in real time, sort of the marginal cost of production here in the US is still high, and it would take a huge decrease in the value of dollar, you know, to make it competitive. So that, you know, that's going to be a tough hurdle to overcome. And it's maybe this is more of a rhetorical question, but I just wonder in terms of kind of the philosophical underpinnings. I know that Trump has been, you know, desirous of a manufacturing resurgence. Certainly, just practically, it's not going to happen anytime soon. But Navarro as well. It seems as though that this is a case of wishful thinking and probably an academic exercise, you know, that may be going wrong. And trust me, I'm about as red as you can be. So this is a tough one to figure
So
out.
Bill, I'm just in a 360 style. I am trying to find someone, not me, but to make the case here. Someone's got to stick up for, what is the Trump view? Is anyone supporting?
I would, Mark, but the more I think about it, it's like this is, unless the game is like overall reduction of tariffs.
Well, 2 weeks ago we had, and then of course they left. We had Mark and John on, Mark Lepresti and John Najarian, and I believe their vision, they didn't finish because they left, was that, you know, we're going to negotiate some good deals and he's going to settle down, to Scott's point. And then we move on, and then we have the election, because they have to get ready for elections. That's the other market. Right.
You know, Mark, trade deals are very complex, and they often take many months, even years, to conclude. And how in the world are we going to negotiate with 75 or 90 countries with all the complexity that exists in trade agreements and actually get to conclusions? I don't understand how that's going to be possible.
I think someone mentioned the Apollo economist. I think he's had a piece out the other day that said they average 18 months to negotiate a trade deal, and we're going to try and do it in 90 days with 70 or 90 countries.
Yeah, it's because we all have AI agents helping us facilitate this.
I will say, Mark, there is one thing that people might not be focused on, is that, you know, we've had a lot of damage done to the markets and the economy, and that valuations have come in quite a bit. If you could get a better sense of what earnings are going to be, which you can't do right now, you would be feeling a little bit better about valuations if you had any confidence in the E. And because they've come in, a lot of the froth that people were worried about last year has been knocked out.
I finally found a disagreement with Mr. Burke. So I don't think U.S. markets are very cheap at all. I've cut my earnings estimate for 2025 from 265 to 248. Based on where we are today, it's almost 20 times earnings. It's still very rich, in my opinion. If I take next year, which I've cut from 270 to 265, I blend those two together, divide by 2. It's still pretty rich. And there's very little equity risk premium in the market, even at today's levels. So I think there's plenty of room to go lower and create more attractive valuations.
Yeah, I didn't say cheap, Scott. I just said the valuations have come in considerably. And I think that the US will do well. I think we're in a bottoming process, not bottomed.
I think we're getting closer to it. The damage has been great that's been done. And I'm not seeing where the other economies had their own problems that have earned the lower valuations that they have.
I'll leave the audience with this statistic. So we looked back at bear markets over the last 100 years. Yes, this includes the Great Depression. So average bear goes down 40% in the last 20 months. I wanted to look at it since 1980, when we went from a manufacturing economy to an information economy. There were 7 bear markets. The average length of a bear market is 13 months since 1980, and the average decline is 34%. We've done approximately 20% in 2 months. So given the circumstances and the massive changes that are underway, I think we will probably have an average bear market since 1980 down over 30%. And so we're 2/3 of the way there. But in terms of time, I think this could drag on a lot longer than people expect.
Michael Hammer's hands up, Mark.
Yep, Michael.
Yeah. Great presentations, but here's my question. Scott, you mentioned about with the dollar going down, increased exports, but it's not simply about money. Look at Canada, right? A lot of Canadians are boycotting US goods. And I think other countries as well, because Team Trump has been very insulting to a lot of different countries and nationalities. And so it's not just the money aspect, it's the politics and the perception of the US, where even if it becomes cheaper, people go, I don't want to deal with you. I don't want to buy your products. You're, pardon my language, a-holes. So how do you overcome that even with a cheaper dollar?
Yeah, you're right, Michael. I agree with you. And let's not forget the retaliatory tariffs on the other side. So our exports may not look as good as we hope they will, because other countries put tariffs on our goods. So in theory, you would get greater exports, but I think you make a great point. There are other mitigating factors that may lead us to not have the kind of export rebound we would hope for.
Wanda?
Thank you very much. Fascinating.
Wanda,
yeah, fascinating comments. So I have one thought and one question. My first thought is about, I think Bill said that Peter Navarro is allowed to do his academic exercise in tariffs. And I couldn't help but reflect on Friedman. He got his Nobel Prize, but thankfully he was not allowed to experiment on the US economy, but he was invited by Chile junta to develop the foundation of the new Chile constitution. 40 years later, Chile is not in a good place, mainly because of the foundation of this constitution, such that the access to education is very expensive and they don't have talent and there are other things. So I only say, too bad that Professor Navarro is allowed to run his academic experiment in the US, because we may have the consequences of this experiment for many years to come. My question is slightly different. So dollar is down 10%, and I read here in the comments that ruble is up 40%. So putting aside the philosophical or political questions about alignment of or misalignment of Russia and the US, what investors should make out of raising ruble in the global economy? How we should think about that? Thank you.
Yeah.
Stephen, I'll leave that one to you. I don't really have an opinion on ruble.
I think the ruble's really a reflection of the fact that it shouldn't be up right now because oil prices are getting hammered. So I'm not sure. I think it's really their war economy is the only reason it's up. I can't really figure out why. Simon?
Yeah. So basically, the situation is as follows: the ruble is strengthened because the exporters had to sell whatever oil they could in one shot, and they got adjusted to the last series of sanctions with the fleet. So the moment they figured out how to sell oil using their kind of outdated, not registered fleet, they used this opportunity to sell whatever they could. That basically meant that Russia got an enormous influx of dollars, and they had the exporters need to convert them into rubles. Given that there is no market there, no market left, that basically depressed the value of the dollar tremendously. At the same time, the stock price dropped to the levels lower than when Trump came to power. So it is a very simple liquidity play. It has nothing to do with the strength or conviction of the Russians or economists. The situation in Russia supposedly is getting worse by day. Economic situation, they are really running out of money. Their reserve fund is running out of money as we speak. So it's not like in the future. Right now, they're close to zero. The inflation is very high and sticking up, and notwithstanding the very difficult situation, because all money goes to the defense industries. They basically print money. People from defense industries buy a lot of goods. That pushes inflation. And most regions in Russia are semi-bankrupt or about to go bankrupt. Not semi, but even the strongest regions have problems, fiscal problems, because all the money of the federal government are focused on the war. So the situation in Russia is very bad. And to reflect on the second part of Wanda's question, the Chilean economy was a wonder of Latin America for 20 years. So whatever happens now has nothing to do just like with the initial ideas. At the same time as he was advising Chile, Milton Friedman was advising Israel and many other countries. The problems were very different. All these countries felt much better afterwards. So I don't think that's a monetary issue or Milton's issue. And finally, there were periods when the dollar dropped precipitously in the 90s, in the beginning of 2000s, for weeks and months in a row. If you think about 1994, which was like a killer year for many hedge funds, tremendous moments, larger than this one. So it's not unprecedented. And even though I don't see the future, but I have been hearing about the end of the currency, dollar as a reserve currency, at least since 9/11, and after 2008. We're still there. The thing is that we cannot say whether or not we'll be successful this time because the measures of the administration are very drastic, and hopefully they will be successful. But it is not a situation when things are so terribly out of hand. Yes, people are emotional. Yes, they buy gold every time in these situations, but it is not out of ordinary. Thank you.
Mark, I want to thank you for hosting me. It's been great to be in front of your audience. I have to run to another meeting.
Thank you, Scott.
Great to be with you all.
Job.
Thank you.
You may be asked back.
Mark, Leslie's up.
Leslie, please. Please, Leslie.
Yes, hi. Thank you very much for both of your presentations. I've got two questions. One is chronologically, at what point might we, another shoe drop on the bond vigilante front in terms of the bond auctions? And second, I'm wondering if this, maybe not in 2025, but in 2026, the stark weakness in the dollar might prove to be an elixir for Asia as we have China stimulus starting to kick in and all the many benefits of a weak US dollar, you know, that we've seen periodically through history.
What was the first question again? I'm mulling the second part.
Sure. No, just chronologically, I'm just wondering when, you know, we might have another event similar to that a week or so ago. It seems like a year on the bond front, you know, at a bond auction or, you know, some other, you know, when will the chickens come home to roost again, potentially?
Well, there's so many different elements that he's reacting to in the White House. So I think it could be anything. It could be it could be the Fed meetings coming up, and if and the president's reaction to what I suspect might be non-action by the Fed. That's going to put more pressure on. He's going to keep dialing that up. It could be either way, a positive or negative on trade discussions. So you just never know where it's going to come from right now, Leslie. I think that's the hard part about what's going on, is there's not a clear end game to what the tariff policies are. What are we really trying to accomplish? That the goalposts move on that. But I suspect one of the big ones will be after the 90 days are up in July, what happens then? Because I suspect that either they're going to say they've had some wins with a couple of countries that will be a kind of a roadmap for other nations, or they won't. And that, so it could be a positive or a negative coming up around that time. But we do have 3 bond auctions this week. I think we have a 2, a 5, and a 7, and we have to see how those go. I think one is today. But we just have to see how the auctions go. But I think Leslie, it could come from anywhere, to be honest with you, the way it's going right now. I don't think there's any one thing you can look at.
Thank you.
You're welcome.
Then on Asia?
Oh, on Asia, I think the weaker dollar will be mixed, because what's really messing with some of these countries is how the tariffs are being perceived as they flow through. So is it finished goods or not? And China was shifting a lot of their production through other countries to get it into the US. And I think they're trying to close off those loops. So it just depends on how reliant you are on whom to see who benefits from that or not. Generally, they should benefit from a weaker dollar, but I think it's going to be tough. I think the puts and takes are going to be, on one hand, you could have a weaker dollar. On the other hand, you could be seeing higher inflationary pressures. So who wins in that environment or not? And they are going to see slowing growth. So it just depends if you get the deflationary element that Bill and Scott were mentioning could be coming out of the tariffs, or if you get the inflation, or you could get both, and there could be a timing issue that you get inflation first and the deflation comes later. So I think that's what's really troubling people right now. So
Thinking
not an easy environment.
A 2026 story.
I think it's too far out to know. I'm not sure the dollar stays down. It's had a big move. These moves tend to reverse themselves. And I think you'll see a lot more volatility in the currencies as well. I don't think the euro deserves to be as strong as it is right now for a lot of reasons. 0.2% growth is projected for this year for Europe. I don't feel like that's a strong economy kind of, we need a strong currency on that one. I think there are other issues that we'll get to. How does the spend get made for the spending that they're trying to do, and how watered down do the policies get that make it harder to see that everything's going to be as one-sided as it's been lately on the dollar. So I think you have to be really careful about going too far one way or the other on the currency moves.
Understood. Thank you.
Scott would have a different take I haven't read his report, but my sense is he believes this is a more permanent change with volatility in it, but more directionally a weaker dollar. I'm not sure that's the case. I don't know. I think it's too soon to know for 26.
Shahram, you've given me that report, but do you have a form that you could provide?
I do have the PDF. I put the link in and I'll put it in again. It's just
Okay.
PDF.
I just wanted to make a plug on as we head to the West Coast. I see you, Lisa. Your name has come up a couple times that we should coordinate with you on Seattle. We've got everything there from Boeing to K&L to Microsoft's offices. So it's a great group's coming together, and that's on top of San Francisco. Just everybody knows it says 16th, but really doing the 15th in San Francisco at Silicon Valley Bank again downtown. Berkeley in the morning, Stanford, and then Cooley again in the afternoon. We'll go to Rosewood on Sand Hill, and then we sort of do some things the next morning, go up to Seattle evening of the 17th, and then the 18th we have a conference activity. But we want to move around and be experiential in terms of seeing different things in Seattle as well. So seeing your name comes up. Anybody that wants to join that call, it's tomorrow at 12 Eastern, 9 Pacific. I think it was one of our best events we've ever had, particularly because of Stanford and Berkeley. So I think I like having them compete to provide interesting content. Of course, there's Riyadh. If you have some of you if you can still make it across, I'll give you all the red carpet you can. We have princesses and princes, but that's not the key. We have really interesting family offices, and we just partnered with their preeminent family office association, and people are asking to join. So that's a great dynamic. So I'm flying there on Thursday. I arrive Friday, but it starts on Monday. If anybody can, and flights to Riyadh are surprisingly less expensive than flying to California. So, by the way, we have a Saudi space. I forget her name. She's on one of these pictures, Lisa.
Did you meet News?
Yeah, I think that's the one, right?
I sent her to you. I sent her to you.
Okay,
Yes.
well,
Fantastic.
Yeah, so that on the speaker side, I look down here. We have a Women with Purpose side, but I have to find where that is.
Al Akbani.
Yeah, small world. Well, thank you for that. It takes a village. That's how this was built, for sure. So yeah, that event has come together. If anybody has any questions whatsoever, come join. This will be a new cadence for the 361 Global, and we are going to Mumbai for the first time. So we'll be talking about those tomorrow as well. Mumbai, and Istanbul.
Hey,
And
Mark, I think I saw on the page there, May 6th, you're going to be in Beverly Hills. Is that correct? Are
yeah,
you going to be there?
yeah,
And is
it's
it
a
this morning only?
It's a flyby. It's lunch. We might do a breakfast too, but it's yeah, breakfast and lunch.
I'll be there. I'll be there most of that week, and I might have another suggestion as well. So we'll coordinate. This is Rob. Thanks.
Yep, sounds good. And I want to overpromise. We are doing Dubai too on the 1st at the St. Regis, which is not on here. We're making the 30th a travel day, sort of like what we're doing the 17th between San Francisco and Seattle. That's not on here. We need to update these to reflect that. But yeah, and then Newport looks great. London. I mentioned Singapore, Mumbai. We're attaching Istanbul. So those are on the radar. This was great that Shram, that you brought, Scott. If other people have other speakers to join these or to do deep dives, when we're back from Riyadh, we'll try to do deep dives on right after these briefings. And at 1 o'clock, Stephen, again, you've got Edward Yardeni. We've had him on a couple times, but yeah, that'd be great if you want, if that, has everyone got the link if you want to join that?
It's it. I put it in the chat. I also, Mark, just put in our latest newsletter. We just published it a few minutes ago. So
fires. I want to ask what it's about, but Parth, you have your hand up? You haven't spoken yet.
Yeah, I had a question for Stephen. You know, I think the tail risk here as it relates to the dollar is pretty well understood, right? Risking our reserve currency status. What, in your mind, I'm curious how you would see things playing out with the dollar if the administration is successful, however you define that, in renegotiating some of these trade deals. So in a best case scenario for how these trade deals get worked out and things normalizing as much as possible, say in a few months' time, how you would see the dollar playing out, and whether that would sort of be a slow burn over time, or whether you think our reserve currency status would remain intact.
I think it's going to be very difficult for the U.S. to, in spite of best efforts, it seems, to lose the reserve currency status, because there's no alternative in any reasonable time coming. The discussion in the chat that I saw throughout the call about what about the Swiss franc, what about these others, is you need scale, size, and depth that is unparalleled with the U.S. capital market system anywhere in the world. The size of the capital markets elsewhere are fractions of what the U.S. is. So I think it's going to be very difficult to do that. I think more likely you would see a erosion of the dollar's reserve currency status over time, not a big bang, unless we completely blow it geopolitically.
Right.
So I don't see that as that's not one that keeps me up at night.
And then the threat to Fed independence, is that something that in your mind just exacerbates these existing issues, and to some degree the perception of our assets and the dollar as the safe haven currency and safe haven treasuries, for example?
Yeah, I'm a big believer in a couple of things: the rule of law, and I also believe that the founding fathers, while not perfect, were really smart about how they created the Constitution and the construct for the U.S. going forward, and believing that in the frailty of man to not always do the right thing. And I think that the checks and balances are important. So I am completely on board with Fed independence. I think central bank independence is paramount for a properly functioning economy, because the conflict of politicians worried about the short term and the central bankers thinking about the economy over the long term are always in conflict, and you need the independence to do the right thing for the reasonable period of time.
I doubt that anyone on this call would question that. I think Parth's question might be to the extent that there is some market anxiety being reflected in the markets, questioning or worrying about that independence. Or do you think, I think earlier on the call, Scott, at least Scott's view was that, and your view is that Powell will go down fighting, but there could be a fight.
Right.
Or they might not go down.
Yeah, I think this is one that I think there's something else going on that we didn't touch on the call today, but there are a lot of court cases percolating right now that will have a big impact one way or the other for the administration. Whether it's there's a Wilcox case that gets into the firing of some government employees, and does that give them the ability to fire somebody like Powell? There is cases going against the administration on the legality of tariffs. There are other things going on that the courts are going to get involved in that will all play into the dollar strength. So it's all part and parcel, Mark, and I think you're going to see legal issues come into play that will create some even greater uncertainty in the short term, because you don't know if the ruling goes against the administration, will they go against the Supreme Court, for example? So I think that's the stakes that are being played right now. And I think we just have to see how that plays out. But I suspect that fights against Powell will weaken the dollar and create disruptions in the markets like we saw yesterday. And I think that's one that I don't know Scott Bessent, but if I had to guess, that is one that he doesn't need to be dealing with right now with all the other problems he has.
Right.
Because if the bond market goes against them more, then that's going to create a real issue for him that he can't necessarily resolve easily. So
Thank you.
You're welcome. Mark, I was asked to repost the link for your Denny. I have to pull it up.
Yeah. Well, if anyone goes to the ARS website, they should be able to navigate to that, right?
Yeah, but I give me 1 second. I'll have it for you.
Okay.
Put in there.
And Melissa, Michael, are those legacy hands up?
No, I've been waiting patiently.
So sorry. I moved devices and I thought I lost the Zoom for a minute. Okay, go ahead.
So one of the things that really hasn't been brought out in the presentations or the discussion is that the impact of tariffs hasn't really started to hit. I mean, the first thing that I've seen, so I have big feet. I wear a 14 wide, and I buy sneakers at Walmart, not because they're cheap, but because I can walk into the store and not always, but a lot of the time, find sneakers in 14 wide. And I just went there, coming back from Pittsburgh. I was at a conference there this past week, and we stopped at Walmart. And the cost of the sneakers, and they didn't have any in my size, had gone from $16.97 to $26.97. And I looked to see where they came from, and they come from China. So I don't know if this was anticipatory of price increases or actual price increases. Now that difference to me that price difference makes no difference. I wouldn't have to give it a second thought. But I think a lot of families who shop at Walmart for price reasons are going to start seeing impacts on their budgets. And especially as we get into back to school and stuff, and they're buying clothes for kids. And I think a lot of people's budgets are really going to get hit by those tariffs. And the supposed relief of manufacturing coming back to the States, or even, we're going to negotiate trade deals with countries. It's not going to happen in a timely manner by comparison. And so, Stephen, you said that these kinds of moves tend to reverse themselves. I just have to wonder how many shoes are going to drop over the coming time frames.
When I say reverse, I mean we're going to be, as I talked about last week, with hypervolatility. I think you're going to see counter trend moves that continue to happen throughout, because we have these unusual policies that are so unusual and are creating pretty significant distortions for businesses or for consumers, that you will have these swings. And as they dial up the pressure and turn down the pressure, you're going to see the reaction in the markets short term.
Okay,
but I think you're right, Michael. I think I don't think that it's come through in necessarily the consumer behavior fully yet, but you are starting to see the paradox of thrift issue come in, where in anticipation of a worse financial outcomes for families, they're starting to pull in spending. And I think that is starting to weigh on businesses, but it'll weigh on different businesses at different times.
So volatility is great if you're a trader, not so great if you're an investor.
I don't know. I think you can. I think it creates opportunities for you to get. In this environment, there have been companies that were really high quality companies that you didn't have a shot at because of they just had run up so much. Now these pullbacks that you're seeing, where you have 25% moves in a day, are creating some real valuation opportunities to upgrade portfolios. So I think this is an opportunity to use volatility to increase quality.
This is one of those times where I'm going to disagree with you. I don't think we've even begun to see the blood in the streets for a lot of retailers and other companies that depend on imports either as their products or as inputs to their products. So, yeah, I think we'll see some movements up in markets, both bond and stocks, but I think that the overall trend will continue to be down.
I want to say on that note, but you want to respond?
I think that's what makes it a horse race. Everyone's bringing their views. There's got to be a buyer and a seller, right? I think you're right, Michael. I think retail is going to be tough, but I think areas of need, areas of required spending are going to attract a lot of capital. I think you're going to see money continue to flow into electrification, to productivity improvements, to digitalization, to healthcare, to the areas that we've talked about all along. I think you just have to be careful about where you're going to do it. But I think that I think the sneakers are part of the problem, but those prices are going to go up. But I think there are opportunities to make money in this environment, and you just have to be nimble enough. And this isn't a invest in the index and everything will be fine kind of environment. I think you have to pick your spots differently. So I'll leave it at there, Mark.
I don't know. Melissa, did you comment? Again, these legacy hands that have been up there for a bit, I don't know. Okay, Samir, and then we'll call it a day.
Thanks, Mark. So to Stephen's point, right, as well as Michael's point just now, the issue is, when you say there are investing opportunities, you're right, but I don't believe they're the kind of investing opportunities we actually need, right? In order to offset the tariffs, in order to actually move in the direction of ultimately dropping the costs in the economy and so on and so forth, we need to be able to make the kind of long-term investments in manufacturing and distribution and whatever infrastructure, R&D, innovation. There's already plenty of evidence that China has outdone us on innovation, right? So in everything, in the whole chip stack, Huawei, for instance, doesn't actually need NVIDIA chips anymore. They've completely replicated the entire fab structure, front to back, so on and so forth. So in order for us to continue to compete, to Michael's point, right, it's very difficult, I would say I'm not seeing investors ready to invest into the kind of long-term or manufacturing or value add assets that I'd say we need to drop costs and remain competitive in the long term.
So come back to our San Francisco event and Stanford. We'll have that discussion. That just was added to the agenda. But sorry to take away from your point. But I unfortunately have to wrap this up in 2 minutes. I appreciate everyone's time and contributions. We will, and if you have other speakers to join, Stephen, that was an interesting way to go with it.
That was a great ad.
Let us know. Let me know. Again, tomorrow, 12 p.m. Eastern, we'll be here on this Zoom talking about the West Coast tour, and to Samir's point. And Riyadh, it's you could still join. Come join us Monday, Tuesday next week, with Thursday in Dubai in the afternoon. it promises to be a game changer in many respects, at least for 361. And then we prepare for new things, Newport, London, skipping something, I don't know. I guess we'll be in LA
Seattle.
briefly.
Seattle and
I'm not
Silicon
skipping.
Valley.
Seattle's definitely part of, that's what I'm saying. Tomorrow, 12 o'clock, we'll talk about, and I have to say, I think Seattle is very well represented on this call. They definitely want us to spend more time there. And they want us to come to your place, Lisa, for some reason. I guess you have a nice place. Is that your?
I wish we could do it, but I'm going to be coming right from New York to figure this out. It's just not feasible, but at some point.
Feasible to join us, but not feasible to host. I hope.
Right, exactly. Yeah.
Okay.
My crazy life.
Yeah.
Thanks, Mark. I gotta jump.
Thank
The
you.
end call starts in
Thanks,
30
everyone.
minutes.
Join at 1.
Appreciate it.
Edward Yardeni. The link's in the chat. I'll leave this open for a little bit. If anybody needs to reach me, I'll be back here in a few.
Thank you all. Bye-bye.
Bye-bye. And Karan, I'll be back in a moment.